We begin with Chapter 16. In this chapter, we will analyze in detail the short strangle strategy. The short strangle position is used when the market outlook is neutral, that is, we do not expect a considerable movement in the stock price. The strategy consists of selling an out-of-the-money call and an out-of-the-money put with the same expiration date. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. The credit received for initiating the position is given by the premium received for the call plus the premium received for the put. The maximum profit on this strategy is limited. The most we can make is equal to the credit received multiplied by the number of shares. With this strategy, we are exposed to losses in either direction. The maximum loss to the downside is limited, but it can be very large. The most we can lose is equal to the strike price of the put minus the credit received multiplied by the number of shares. This occurs if the stock price falls to zero. On the other hand, the maximum loss to the upside is unlimited, because the increase in the stock price has no limit. So be very careful with this, because with this strategy, we are exposed to a loss that can be very large. This strategy has two break-even points. A break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the put minus the credit received. On the other hand, break-even point 2 is equal to the strike price of the call plus the credit received. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a losing situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a profitable situation. Continuing with the analysis, the amount of initial margin depends on the broker. In some cases, it can be very large. An increase in volatility hurts the position. Time decay helps the position. With respect to exit conditions, to close the position, we must buy the call and the put. If the stock price is higher than break-even point 1 and lower than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the ones shown in green. And finally, at options expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the gap between break-even point 1 and break-even point 2 increases, and as the gap between the break-even points increases, the range of prices for which we are in a profitable situation increases. Therefore, in this case, time decay helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Coca-Cola Company. As we can see, on April 26, 2011, the company reported earnings. As we said, on Tuesday, April 26, 2011, Coca-Cola reported earnings. After that, we could have expected that the stock would not move significantly for a while. In order to take advantage of that, suppose at that time we had decided to enter a short strangle. At the close of April 28, Coca-Cola was trading at about $67.5, while the options expiring in June 2011 had a premium of 30 cents for the 70-strike calls and 60 cents for the 65-strike puts. Thus, we could have sold 10 calls with a strike price of $70 and expiration in June 2011 at 30 cents, and 10 puts with a strike price of $65 and same expiration at 60 cents. With 10 contracts, we would be in control of 1,000 shares. So we would have received a credit of 90 cents per share, that is, $900 overall. We must also consider that a margin of approximately $11,000 would have been required to open the position. And notice that both the call and the put are out of the money. During the following weeks, the stock was trading between $66.5 and $69. Finally, on May 23, it closed at $67.5. That can be seen here. We initiated the trade on April 28, and during the following weeks, the stock was trading between $66.5 and $69. Finally, on May 23, it closed at $67.5. At that time, the premium of the call was 10 cents, and the premium of the put was 40 cents. If we had closed the position at that time by buying the options at those values, we would have had a debit of 50 cents, so our profit would have been 40 cents per share, because the credit received was 90 cents per share. Thus, we would have had a total profit of $400, making a 44% return on investment in only 25 days. Later, on expiration Friday, June 17, the stock closed at $65.6. That can be seen here. After May 23, the stock was falling until it closed at $65.6 on the expiration date of the options. At that time, both the call and the put expired out of the money. So if we had held the position, we would have made a profit of 90 cents per share. That is, the total credit received from placing the trade. Thus, we would have had a total profit of $900, making a 100% return on investment in 50 days. Here we can see the numbers of our example. The strategy consisted of selling 10 Coca-Cola calls with a strike price of $70 and expiration in June 2011 at 30 cents, and 10 puts with a strike price of $65 and same expiration at 60 cents. The credit received is equal to the call premium plus the put premium, in our case 0.3 plus 0.6, which is equal to 90 cents. Therefore, our investment is equal to 0.9 multiplied by 100, which is the cost of the strategy per contract, multiplied by 10, which is the number of contracts. That's a total of $900. This money is credited to our account. The initial margin depends on the broker. In this case, it would have been about $11,000. The maximum profit we can make is equal to $900, that is, the entire premium received for the options. If we had bought the calls at 10 cents and the puts at 40 cents, we would have made a profit of $400. The maximum loss to the downside is equal to the strike price of the put minus the credit received multiplied by the number of shares. That is, $64,100. This occurs if the stock price falls to zero. On the other hand, the maximum loss to the upside is unlimited because the increase in the stock price has no limit. And regarding the break-even points, break-even point 1 is equal to the strike price of the put minus the credit received. In our case, 65 minus 0.9, which is equal to $64.1. On the other hand, break-even point 2 is equal to the strike price of the call plus the credit received. In our case, 70 plus 0.9, which is equal to $70.9. Here we can see the order we must enter to open the position. It is an order with two legs. Leg number 1 corresponds to the short call and consists of selling 10 Coca-Cola calls with a strike price of $70 and expiration in June 2011. Leg number 2 corresponds to the short put and consists of selling 10 puts with a strike price of $65 and same expiration date. The entered price is given by the sum of the selling prices of the call and the put. In this case, 0.3 plus 0.6, which is equal to 90 cents. This is the money, expressed per share, that will be credited to our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with two legs. Leg number 1 consists of buying the calls we had sold. Leg number 2 consists of buying the puts we had sold. The entered price is given by the sum of the purchase prices of the call and the put. In this case, 0.1 plus 0.4, which is equal to 50 cents. This is the money, expressed per share, that will be debited from our account when the order is filled. Here we ended with the chapter Short Strangle. In the next chapter, number 17, we will analyze in detail the ratio call spread strategy.